Welcome back, everyone. Welcome back to our free biweekly webinar series. This is actually our final webinar for the year. It's been over a year that we've been doing this, so it feels like a nice achievement to get to the final one for the year. Along with my partner, Fasanya of Dr. Breathe Easy Capital, I'm your co-host, George Ozoude of Time Health Capital. This evening, we bring on another investor doc, who I had the chance to chat with and meet because he's down here in Houston as well, Dr. Tait of Vernonville Capital. He's founder and president of the firm, which has been investing into assets ranging from multifamily residential, commercial triple net projects, and many more. I'm thrilled to bring him on and learn from his extensive experience in investing, which spans nearly 2 decades. He has many other feathers in his cap as well. He's an MBA from Rice University. He is co-founder of Urban Capital Network, which focuses on early stage startup investment opportunities. He's a sought after speaker and author. And on top of all of this, of course, he's a practicing physician in internal medicine, and he's president of the Pinnacle Management Organization. Tonight, we bring him on as our final guest speaker of 2023. And I'm actually very excited about the topic of discussion, which is both a look back at the year of 2023 in multifamily, which has been very challenging. So we're going to dive into that. And then we're also going to look ahead and take what we learned from 2023 and figure out what we can do strategy-wise for 2024, considering all the interest rate variations and variability. With that, I'm going to hand it over to Eric. And I know that was a high level. Please definitely tell us about your background and fill in any gaps, and then we'll go into the topic.
Absolutely, yeah. I'll give since I don't have a presentation per se, we might have a little bit more time, so I will give a little bit more in depth in terms of my background and just my history. So again, Dr. Tait, internal medicine physician here in Houston, but I'll get to that at the end of the story. Originally from Mount Vernon, New York, so that's the name of the firm. Vernonville Asset Management is basically an homage to the town I grew up in. I went to Morehouse College in Atlanta, Georgia, then came to Houston, as you said, for graduate school, did a dual degree MD, MBA between Baylor College of Medicine and Rice University. Did that was a dual degree, same time program. After that, went down to UTMB Galveston, on Galveston Island, did my internal medicine residency there, came back to Houston, joined a mentor of mine and his partner in general internal medicine practice for the first 4 years of my career. I was with those gentlemen. But on the side, what I was doing was building my own real estate portfolio. So this was 06, 07, 08, 09, when I'm getting out of residency from that standpoint. So we were right in the beginning of the great financial crisis. And so I came to Houston, did some mentorship, learned how to do some small single family things when I first got here. So I bought my condo when I was in medical school. I rented it out when I was in residency. So I guess technically that was my first kind of investment property, first piece and taste of kind of passive income when I was a resident. And while I was in business school, the Enron debacle happened. Enron was a huge recruiter from Rice at the time. And so I got to see firsthand how that took down, in many ways, the confidence and many people's 401ks in the Houston market, because if you remember correctly, they encouraged their employees to load up on their stock. And what was wild about it was I was a biology major in college. And so I had never done an accounting class, a finance class, a business class, though I had run small businesses when I was in college, before I went to college, just in and around to put money in my pocket. But the first financial accounting class that I ever did was summer of 2000. And we did Enron's books. So we did their books from 97, 98, 99. It's all public information. The thing about business school is they say, go get the 10Ks and 10Qs, break down the financials on an accounting basis, and go and look at their core operations and see if these guys are making any money. And so for 97, 98, 99, their earnings from core operations have been negative. And I remember the professor circled 3 negative numbers in a row for those years and said, the IRS could classify this company as a hobby. And so it was at that point in the summer of 2000, I sold all my stocks. I had mutual funds, little things like that, sold them all, got out. But interestingly enough, Enron stock price continued to go up. And so to me, that just meant one of two things. One, either the boys in Wall boys and girls on Wall Street don't know what's happening, or two, they know and they don't care. But either way, I figured out very quickly, I didn't want my money anywhere touching Wall Street at all in any way, shape, form, or fashion. And so I actually did business school to go to learn how to invest my own money, because I never was really going to try to be in medical management, though I have medical directorships or anything of that nature. What I really wanted to do was learn the language of investing. Now, interestingly enough, the MBA didn't necessarily help me with the real estate side of things, but it has helped me sit on boards, do some private equity investing, definitely has helped somewhat with the venture capital investing we do. But on the real estate side, I really had to find local mentors to learn how to do those kinds of things. And for me, what I wanted to figure out was how to become financially independent as fast as possible. And there's only two ways in the United States you really do that. It's either non-service-based business ownership or real estate. And so I knew I wanted to practice medicine. And so the non-service-based business was out because it don't get more service than a medical practice. And so then I focused heavily on learning how to do real estate. And then that's really what we started from. Yeah, that's really the kind of the beginning of my career, was single family homes, which I still own dozens of those, and small multifamily, which I don't own right now just because, and we can talk about why we pivoted out of multifamily back in 2018, 2019, if you want to go down that pathway. And that's more of a forecasting pathway and understanding kind of cap rates and markets and things of that nature. But so I did 10 years internal medicine traditionally. 1 day a week I would always reserve for my investment. 4 days a week I would work. And then basically when I was 40, I got to the point where I replaced my earned income from being a physician. And again, I'm a primary care doc, so it's not like it was a ton back then, but still, once I did that, I flopped it and went 1 day a week medicine, because I had some contracts that were capitated contracts and I had partnership with insurance companies. So I was able to get paid in a way that allowed me to do that, because 95% of what I do as an internal medicine physician is cerebral anyway, and went to then essentially full-time investing. So we had moved from doing the smaller deals to much larger hotels and coffee plantations and large commercial deals and large multifamily projects and retail centers and light industrial centers, and then moving and creating venture capital firm and learning that process and doing some private equity and angel investing. So I had then had the time to really devote to that in a way I did in the first 10 years of my career, when I was just focused on practicing medicine and building enough capital to be able to get free from practicing medicine every day. So I'll stop there because I put a whole lot out there, and I'm going to let you pick and choose what you want to take from there and what pathways you want to go down.
I think that was very important, though. It set the table for the rest of the discussion. It's going to be a discussion where we want to learn from someone who has experience. And you going through a downturn in 2006 through 2008 gives you that experiential capital. And now going through this headwind that we just went through the last 2 years, it's going to be very important to learn from someone who has this experience. So I want to continue to set the table. We really want to talk about capital calls, because that's been the big thing with interest rates this past year. And for those who don't know on the call, who don't know what a capital call is, it's when an investment group goes back to the original investors and requires more capital for whatever reason. And in this case, over the last 2 years, the rising debt service as an effect of the interest rate hikes have caused a lot of syndication companies and operators to go back to their investors, their limited partners, and ask for more capital. And so we want to look back at the year of 2023. Eric, why do you think we ended up with such a huge headwind and therefore all these capital calls? What led up to this? What are the kind of the mechanics, the pathophysiology?
Yeah. So it really gets back to why, one of the reasons why we pivoted out of multifamily 2018, 2019. And I had been in and around, even though I wasn't buying large multifamily, I'd been in and around multifamily since 2012-ish. So I understood how that operates, what are the underlying driving factors for it, and things of that nature. And so for me, it ended up being, there's two things. So I started as a macroeconomic guy, right? So I look at macroeconomics, I look at through a lens of Austrian economics. So for those of you that may not be familiar, most of what the Fed practices and most of what everyone talks about, whether you went to regular business school or business schools and undergrad or read courses, is essentially Keynesian economics, essentially, right? There's some bastardization here and there, but Keynesian is what we'll call it. And that's the framework the lens through which most policy is put forth from the federal government, which essentially is fiscal policy, so tax and spend. And then there's monetary policy, which is what the Federal Reserve does, which is interest rates up, down, changing the reserve ratios for banks. But essentially what they're trying to do is say either money's easy to get or money's harder to get, right? That's just an easy way to look at what the Federal Reserve does. One thing I want to make sure you all understand, and you can go down this pathway on your own time, the Federal Reserve is not federal. There are no reserves. It is a private corporation of the largest banks and is a private corporation. And so there is nominal oversight from the federal government in terms of who they pick as the Federal Reserve chair. But if you go down the pathway of look at who owns stock in the Federal Reserve, it's all the large banks. So that's why you will always end up with bank bailouts no matter what, as long as you're a big enough bank. But people don't get bailed out, banks do, because banks are the ones who control essentially the monetary policy, and they wink, nod to the political class and the president. Remember, presidents come and go, Congress people come and go, senators come and go. Banks are essentially forever these days, and they've made it in that way by being a member of the Fed, being able to bail essentially themselves out. So let's put that political rant to the side. Being a macroeconomic person, the things you want to look at are, of course, interest rates, but interest rates respond to what's happening in the market, whether inflation is going up, down, left, or center. The one thing you want to understand is that baked into Federal Reserve policy is a minimum 2% interest or 2% inflation, no matter what. That is their stated policy. So they say if you have $100 at the beginning of the year, you will have 98 at the end of the year, no matter what. That is stated policy. To me, that's complete theft. One of the reasons why we invest in real estate is to try to get to buffer our own incomes and wealth against that, but understand the stated policy of the Fed is to increase the monetary supply. That's how it's done. What they can never have essentially is deflation, meaning that prices go down. Why is that? I won't go into a long treatise, but if prices go down, banks go bankrupt because we're in a fractional reserve system. There's very few reserves in banks. If the value of those reserves go down, only 1 or 2 or 3%, the whole kind of capital stack of banks can fall. Again, I will not bore you with how that is, but just understand the Federal Reserve will never allow prices to fall. So they will deal with inflation and try to tamp that down. What they cannot have is deflation. So if you understand that they're always going to be relatively accommodative in policy, meaning that interest rates are going to be on the lower side from a historical standpoint. And because I'm a little bit older than probably a lot of you guys on this call, I was around when Greenspan, after the dot-com, basically put interest rates at zero for a long period of time. And that's what essentially created the great financial crisis. So all that loose money found its way into the bond market, mortgage-backed securities, and that's what you ended up with from that particular standpoint. So if you understand the history of the Fed in terms of what they do, you can see where the bubbles are going to come when they bring interest rates down. And so interest rates have been down for so long, it created these asset class bubbles that were happening. At the same time, when inflation is up, people's incomes did not keep up with that. And so if you look at it, there's something called kind of renter nation. And my investment thesis when I started Vernonville was we are moving into a renter nation. This was 2011, 10, 9. Go back to White Coat Investor, look at me and Jim battling back and forth on his message boards. I've been wildly consistent about the Fed, inflation, the destruction of the dollar, theft, all of those kind of things that are happening behind the scenes. And so you end up with these booms and busts. And so from that standpoint, when incomes don't keep up with the rise in costs, ultimately, in the end, as real estate people, incomes are what we care about, right? Because we're just renting time. Doesn't matter if it's a single family home, an apartment, retail, we are renting spaces of time to people. And then we have to look back and say, okay, what is the income stream that's going to pay us? For our triple net retail stuff, we know the income stream is a business, right? But behind that business is consumers. If it's residential, it's jobs, right? Jobs with the government if you're doing kind of HUD kind of thing from that standpoint. So essentially, you have to look at people's incomes. And so 2018, 2019, 2021, 22, we had essentially a very accommodative policy from the Fed, meaning rates were very low, okay? Rates were low. People had made money coming out of the great financial crisis, so properties were changing hands. And when rates are low and people are gathering money up together, you get what's called cap rate compression. Cap rates are just the price with which, let me back up. Cap rates at their base are if you buy a property all cash, it's the cash on cash return you would receive at the end of the year. So if it's $1 million property and a 10% cap rate, you're going to get $100,000 in your pocket, right? It's just simple, easy math. But cap rates are a way that you can compare properties across different asset classes because they don't take into account debt, right? And so what I was seeing in multifamily in 2018, 2019 was that cap rates were coming down. The things that I was looking to buy that were 18 a door, 20 a door were now 35 a door, 45 a door for C class in the hood. I'm like, these people ain't got that kind of income. What the hell's going on? And all I did was just watch those prices continue to rise and rise. And the prices with which people were paying for the properties were not matching up with the income that was going to be needed to maintain that. And so if you look at pro formas that were happening from 2018, 19, 20, 21, 22, those pro formas are what I like to call being priced to perfection, meaning you needed 90% occupancy at future rent growth of 5% 2 years from now to make your pro forma, right? I just didn't have any confidence that was going to ultimately happen, right? And some of that has been borne out because what we didn't factor in and I was looking at that with interest rates low. What we didn't factor in was technical defaults because interest rates now went up and your DSCR ratios, meaning your debt service coverage ratios, were now out of whack. And so when we talk about defaults and we talk about capital calls and the need, there's two big buckets that I look at when you all are thinking about this if you're being asked for that, right? And the two big buckets are, okay, we're in technical default because interest rates have gone up and we need to refinance this property, which means that we've done everything we're supposed to do. We've hit the pro forma numbers, occupancy is where it needs to be, income is where it needs to be. But because we have to refinance at a higher interest rate, we need money to come to the table because the bank will not lend to us because the loan to value must come down. Cool. That just means that, all right, you got to wait a little bit longer. Time might be on your side from that standpoint. All right. As we say in real estate, time heals most wounds. Your GP, your general partner, the person who put the deal together, the operator should come back and say, hey, if this money comes in, interest rates are going to be here. This is where it's going to be. We probably won't have any cash flow for the next year or two. We will then refinance on this interest rate curve from here. But even if we don't, we'll still have protective equity. So if we decide to sell, this is what you will make, even with you putting this money in. Someone comes to you with a plan that looks like that. That's a real consideration to say, okay, we're going to put some money in. The other side of it is when forget interest rates or a deal got done at a higher interest rate than expected. They push the deal through and they can't get the occupancy nor the rents to where they need to be. And so they need money from you all just to make the monthly nut, just to make the monthly payment. That's a very different situation because there's not much income growth that's out there right now. If you look at it, credit card delinquencies are high, are 30-year highs. People are stretched. People are using credit. So there's not a lot of cash out there. So you're not going to be able to raise those rents to 3 and 5% that you had on that pro forma when you got into that deal. And so that kind of deal, you might want to think twice about putting capital in because what we call it is chasing good money after bad, if that makes sense. Putting money in to get a refinance done because you still want to own the properties is one thing, right? You could always turn around and ask, hey, could we just sell the property, take our equity and go? If there is no equity, even at the new interest rate, because cap rates have now uncompressed or gotten back higher, meaning that people are expecting more for their money, right, then that's a tougher conversation to have. But your general partner should walk you through kind of those options and what it looks like down to those kinds of minute details. If you're being asked to put money up because they just completely missed their plan, they can't get their occupancy up in place, if there's not a mechanism through which they are no longer running the project, meaning they're bringing a new management company in, there's some preferred equity that's going to come in and take them out and learn how to manage a project, I would personally think twice about putting money into a project like that, trying to save it. That's good money after bad from that particular standpoint. So those are the two big areas that we're seeing in terms of trouble, in terms of what's happening. The refinance thing is one thing. The third thing is you're caught in a floating rate debt, which essentially is the same. It's an in between the two. So if you're in a floating rate debt, if you're in a floating rate kind of mortgage, same issue. Okay, it's high now, right? You're paying 8-9%. It may be amortizing. Cash flow is being sucked out of the deal. Okay. They're not able to refinance because technically the debt service coverage ratio will not cover it. But if you put money in, they will be able to refinance and the property will then be restabilized. That's another time where you might consider doing it, right? Because you're like, okay, all we need to do is get interest from 9 to 7. If we can do that, okay, here's another X amount of dollars percentage in to get us to be able to do that. We have new debt on the project. Oh, and by the way, we're still running through plan. That's a different kind of model. So it's the three things: floating rate debt, just bad management, and then refinance, DSCR. Those are the three big things that people are getting caught in right now. And each of those has a different exit strategy based upon your general partner coming to you and explaining what the future plan is from that standpoint.
I just want to, we got some questions already, but I just want to quickly follow up on that and ask about another scenario. Just the scenario of that first example where things are going well, business plans being carried out. They're just coming to the partners, the LPs, for more capital. What does it mean if you don't decide to participate? Even though the business plan is going, you just need more runway. If rates go down, then this starts to look a lot better, but you have chosen not to participate in that capital call.
So that's when you have to go back and pray that you read your PPM documents and your operating agreement, because your operating agreement will spell out what happens in that scenario. So I can give you an example of my operating agreement. My operating agreement does not force people to come up with the dollars, but it does tell you if you do not come up with it, you will be diluted if we bring new capital in, right? Some have punitive capital call measures that do require you, and if you do not, then they may charge you three times. Essentially, now they look at it as a loan coming into the project from somewhere else. So they're going to charge your capital account a certain penalty rate because you didn't do that, and then your pecking order falls back. So you have to go back and look at your operating agreement and see how it spells out what the provisions are for the capital calls, because the general partner has to hew to that operating agreement that they gave you for he or she to have used the exemption that they used in terms of putting that deal together from that standpoint. So you really have to refer back to your operating agreement and your PPM that spells out what happens with capital calls and what happens if you do or do not put in. If you put your money in pro rata, then you're going to maintain the same amount of ownership. If you have the ability to put more in because you just really believe in these guys, then that's a good way potentially to get more ownership in the deal at potentially a better price point, possibly. So you just have to go back and look in your operating agreement and PPM to see how it's spelled out, how capital calls will be handled.
Yeah, I think that's a very key point. One of the most important things to look at as an LP on that operating agreement is the circumstances surrounding a capital call.
Yep. Always read your operating agreements, always read your PPMs, and always read your quarterly statements. Please, God, for the life of you all, please start reading it, because most of the things we're going to tell you in it. So if things are going bad or good, it's going to be in there. So you're not going to be surprised. It's going to be like, hey, we're telling you what's going on. So please read your quarterly updates. Please and thank you.
I'm going to actually piggyback on that again. Thanks for that. In terms of the PPM, that's actually one of the reasons why we're doing the limited partner course, making sure that people know what legal documents they're reading, when they commit, what does it mean? And in this kind of situation where you don't know what you're doing, you just sign, right? And then you don't know how to get out of it. So I'm going to piggyback on the first example that you said. For example, most of our deals, right? We have fixed interest rate, actually all of our deals. So unless you fail to refinance when the rates are low, most people should still have about maybe 2 or 3 years left, right? On the, if it's 5 years or 3 years, you still have some time left. I don't understand why there's going to be capital call, because if they're really running, they could basically cash flow till infinity, right? Until they have to be forced, to refinance, right? Or sell, right? So if your 5 year, your 5 years in 2026, you just keep writing it with cash flow. You tell your investors, obviously, that, look, we're not going to be able to sell. We're not going to be able to refinance, but you still continue to get your returns.
Yes. So yes. So, well, there are a couple of variables in there. The big variable is that it's being operated to plan, and that if you're in a fixed rate, we only have one property that's on a floating rate. Everything else is a fixed rate. So that's not true. We actually are going to probably sell something just because we're getting a ridiculous offer. But we have no desire to necessarily sell anything right now in this current rate environment. So that's the perfect place to be in. If you're getting cash flow every quarter, you sit back, relax, life is good. The issue comes in if it's not on plan, or if there's been massively unexpected expenses that have gone up. So take a place like Texas. Insurance and taxes are massively out of control. Florida, same way. And so you pro forma'd a 5 to 10% increase in insurance, you got a 40% jump, right? And so, especially if you're talking about residential or multifamily, you can't pass that through. That's the difference between kind of triple net and essentially gross leases, which are what happens in apartments, are gross leases. And you might build back a rub system if you're billing people back for their water. If you're super sophisticated, you're billing back for their trash. But most properties aren't necessarily doing that. But what you're not billing back is for insurance, right? That has not moved into the multifamily space as of yet, right? Y'all might want to move to that space, move to that soon, because you have to eat that at the level of the partnership and then hope that you can raise rents next cycle around to catch that back up. Again, but the issue that I see is a lot of folks, you're at the top end of people's incomes, right? So if you look at a 2-bedroom, 1-bath in most major cities in this country, someone with a regular job can't afford that. And so where are you raising rents to at that point? And so how do you catch up when your insurance has doubled and your taxes have gone up by 1/3 and they're still coming after you every year for that kind of thing? And so that's where you might need capital, because you might be in technical default even on your fixed rate deal, because the amount of income you're bringing in is no longer covering the expenses at a 1.25. Now, in a technical default, as long as you're making your mortgage payment, nobody cares. But when it comes time to either refinance or sell, your NOI is down because your expenses are up. And so in many ways, that equity got eaten up by your increase in expenses, even though you're on plan when it comes to occupancy and rents. You're off plan when it comes to the expense side, because people forget that inflation cuts both ways. It cuts on our rents, but it also cuts on our expenses. And so the question you have to ask yourself is, how do you begin to mitigate that in certain ways? And it's been very hard, because you had the twin increase in interest rates we didn't anticipate, and then the bump in taxes and especially in insurance, which none of us expected. And so that's very hard to eat on a gross rent basis, which most multifamilies are in. And so you have to be really dig in on your expense lines while you're waiting out interest rates to come down. This is the time to be optimizing your operations in anticipation of a future either sale and or refinance from that standpoint, if it's a trophy asset that you ultimately want to keep, or a recapitalization where you get your regular investors out and bring in a new group of investors because you want to really keep this property as the operating partner. So hope that is helpful from that standpoint to think about kind of what I've been seeing in the market recently as it relates to that.
Yeah, what I've also seen similar to that is on the floating rate side, deals that bought this variable rate debt are also dealing with the cost of buying rate caps. So all of that you just said is still in play, plus the expense of a expiring rate cap, which many of them expired this year. Many of them are expiring next year. Added expense, right?
And some of it will blow your deal completely up, right? And the problem is you're already in, right? You didn't anticipate paying 3x your rate cap, which is nowhere in your pro forma. From that standpoint, it completely blows your deal up, right? And we're just in times where lots of things are moving, and so it helps to be conservative. The way we look at it is, and I tell people this: manage to mediocrity. What do I mean by that? And I don't think we're mediocre managers, right? We always try to be excellent in everything we do, but our floor is mediocrity. You're never going to beat the market rent. If you do, you're lucky, but you can't bet on that. Same thing with market occupancy. You might if you're a great operator, but don't assume that you will. And so I always say that we look to be able to make our 3 to 5 year pro forma on today's rents and today's occupancies. Meaning, if rents don't go up and occupancy is maintained, all we have to do is take the current rents of the property to today's rents, not over, just to today's rents, and to today's average occupancy, and we will hit our pro forma, right? That does not require rent growth, does not require occupancy growth. It just requires that you buy it at the right price. Because ultimately in real estate, all we're solving for is 2 equations, right? Or 2 variables, right? The price we're paying and what we want to make. And what we want to make is directly correlated to the price that we pay, because we can't control insurance, as we've seen. We can't control taxes. We can't control market rents. We can't control market occupancy. Those are all plug numbers into your pro forma, give or take. So the only thing we're really negotiating is price. Either I'm going to get it at the price that's going to give me that 7, 10, 8, 9 cash on cash return plus some future upside, or it's going to be a 3% cash on cash return. And I'm like, I have no use for that because I can just buy an AT&T stock, or I can just go get a treasury bond. So with that understanding, that's how you keep your emotional discipline as it relates to buying and selling these assets, right? And so if you have to overperform in any of those metrics, right? If you have to overperform in terms of getting your expenses down, you have to overperform in terms of market rents, if you have to overperform in terms of market occupancy just to hit your pro forma numbers, you shouldn't do that deal.
Yeah, you definitely make money when you buy. That's for sure.
I think another variable you can look at on the front end as an LP, love for you to just comment on this, Eric, is the type of debt. Is it fixed rate or is it floating debt? How should LPs look back at this year and analyze how they were assessing the debt when getting into these projects? Should we be more fearful of variable rate debt projects versus fixed rate? You guys both mentioned you mainly do fixed rate. Is that the way to go, or is there another step?
So it's funny, right now we're doing owner financing right now. So we just closed on a 3-pack warehouse. What day is it today? Saturday? Thursday?
Saturday.
Wednesday?
Yeah.
Thursday? Because we like light industrial stuff. So we just closed on 3 light industrial properties this week. And that is owner finance, right? Group of guys in their 70s. My partners had bought up another one of their properties. They've got 14 more. So we're going to slowly, just while this interest rate market is doing what it's doing, we're going to slowly try to pull some of that stuff that can be owner financed. My crystal ball is always cloudy, but again, because I'm a macroeconomic guy, where interest rates currently are, the United States is going to pay roughly $1 trillion in debt payments next year, which is more than a third of the taxes we will collect. So that will crowd out everything else, which means we have to borrow more, which then causes more issues with the dollar in terms of weakness. So the Fed is essentially at the limit of what they can do. And as long as inflation is just semi-tamping down, they really don't want to go higher than this, right? They really want to take it down. They may keep it here for a little bit and then take it down, but they can't really afford to go too much higher than this, just from the standpoint of what the federal government's going to have to pay. So if I were a betting person, if you get a variable rate debt prime minus something, you're probably going to be okay. I'm not going to lock in 7% debt in this market. That's just not going, unless I get it at the right price. But no seller is going to want to take a 50% haircut on their equity because their cap rate is now 3 at 7% interest rate when I need it to be 7 just to even think about getting into it, right? So there's just a whole lot of mismatch between buyers and sellers based upon where interest rates currently are. So yeah, the safest thing you can do is lock in fixed rate debt. But the problem is the prices at which you're going to lock it in right now aren't going to make most deals pencil because most sellers are not willing to take a haircut because they still think it's 2021. So they still want 2021 pricing. They don't realize that, no, my friend, we're in 2023. Cap rates have expanded. That 30% equity bump you thought you had, that's gone, buddy. And they're doing exactly what you were saying is, well, we'll just keep it and just let it cash flow and I don't need to sell. So that's why you've had a massive decrease in transactions everywhere. That's why brokers are going out of business and starving and having all these issues because there are no transactions right now because the price discovery mechanism is just off. Because if we're locking in rates at 7, my cap rate has to be above 7. Otherwise, you're negatively geared. So there's no way it's just not going to happen. So that's what's happening right now. So yeah, I would lock in fixed rate debt, but the pricing has to be so low on the asset. Most sellers aren't going to want to sell it at that price where 7% fixed rate debt makes sense for a long-term 3 to 5 year hold.
Yeah, I agree with that. So what everyone is doing now is creative financing, right? So you may not be able to do all of the owner finance. Sometimes you do a pref equity. We actually had a deal that we end up walking away that the owner was going to leave a couple of $1 million in the deal as pref equity. So then we're going to be getting a little bit less loan. And another one is loan assumption, right? Yep. You have the 3 points. The one we just closed a few days ago actually was 3.9%, and it still have a good runway on it. But you can still, on my side, I would say we still don't do the underwriting with the fixed rate. However, if I'm a betting man too, I do believe that if you weren't going to do a variable, probably now is the time, right? Because the Fed's already signal reducing the rate. Even if they don't reduce, maybe perhaps they'll stay the same, right? Mm-hmm. It's going to be a black swan event for them to raise it, because right now we're between keeping it the same or actually dropping it like 4 times next year. So So that's what I'll say. So a variable is not always the wrong way. It's just the miscalculation of syndicators and operators that they thought, okay, the Fed is going to just increase it like 3 times or 2 times, right? And then they, increase it by 8 times. How much they will just keep going. So there's just a miscalculation on that side. So
I agree. I think it's about understanding the macroeconomic cycle and understanding where you are in that cycle. If you're at zero interest rate environment, there's only one way for that interest rate to go up. And if you saw the inflation coming from the money printing 2, 3 years ago, you could have assumed that rates would start rising. And so avoiding variable rate loans at that time probably would be hard to do, but it would probably be the prudent thing to do.
Yeah, but I'll be honest with you. If you look at the Fed kept rates under Greenspan long for a ton of time. We got to 9 trillion in Fed balance sheet. And it really wasn't until, and I'm not blaming this on Biden, right? Ultimately, it was PPP, it was all the money that went out during COVID. But the Fed had been increasing its balance sheet over the past 20 years, right? More debt has been created in the past, 4 or 5 years than at all time in the history of the United States, 200 and whatever years we are, right? So no one knew what the specific tipping point of Fed balance sheet, and it may not even have been the Fed balance sheet, right? It may have been the fiscal policy of flooding the U.S. with those dollars in an environment where the supply chains were messed up from the virus, right? And so that required the Fed to raise rates faster than any time in its history. So there's a whole graph out there that talks about that, back to the macroeconomic side of things. Because the one thing that Jerome Powell was very clear on, he was going to use the Volcker model, because ultimately they pretend like they don't know, but they know exactly what they're doing when they're increasing the monetary supply. That it will create inflation. They know that. They pretend like they don't. The Federal Reserve has more PhDs than any institution on the planet. They study Austrian economics. They understand this, right? And so they knew that jacking up rates was ultimately going to work, because jacking down rates is what caused it. Now, they'll never say that, but you'd have to watch it to see what they do. And what they did was the exact opposite of what they had been doing. Now, interestingly enough, the Fed balance sheet hasn't gone down a ton, but it's still gone down. It's still contracted. The money supply is still contracted. And in many ways, that's enough to signal, hey, all right, we need to tamp this down from that particular standpoint. But there was no way to know that the virus was going to create such a huge fiscal stimulus from the federal government that really put us in this space in this kind of way, with the perfect storm of supply chains, right? So there wasn't a good way to predict that they would have to jack up that fast in such a short a time period.
That was unprecedented. That fiscal stimulus, that's never happened like that before.
Exactly. But most black swans are that way. You have to understand that the thing you don't expect is the thing that's going to happen. It may just not happen in the window that you own an asset. But the thing you are working for on the downside in terms of your model is likely going to be worse than that if that kind of world-changing event happens. And we're all big boys and girls in this. We have to understand that, you know what? Cool. We didn't win on this one. This cycle wasn't great for us. We will think differently about this, right? And what we don't want to do is punish people for not understanding this. Some people did flagrant things, right? I'm never going to cut for an operator or a syndicator who you had to have 95% occupancy with 10% rent growth for the next 2 years to make your money. That person that's just malfeasance, and they're just raising capital. They don't know what the hell they're doing. But there are people who took prudent steps, who are going to lose money, whose deals are going to go bad in this time frame. They will be smarter investors for it. And the best time, they say, what's the best time to fly on a plane? After a crash. The best time to invest with somebody is right after they've lost money, because they're going to be wildly prudent around certain things in terms of what messed up. Now, if they're a psychopath, it's a different discussion. But if they have other deals that are going well, and this was just, they have 1 or 2 bad ones, they've learned something in that process. What you don't want to do is go with the person who's never lost money, who's never had a bad deal, because then they're going to have that bad deal on your money, very likely. And so we have to use this time as a time to where we're hardening and learning, as opposed to punishing. Flip side for LPs. The only way you lose money in this game is if you stop playing. Because right now, a deal goes bad, you don't want to give capital calls, they can't do it, they give the money back. you're going to get a negative K. You're going to get a K1 with a capital loss on it. Again, I am not an accountant. Talk to your accountants. But we've done this on deals. The previous president has done this, why he never pays any taxes. The beauty of being in private investments is there is no cap on your losses in terms of it being able to roll forward, again, check with your accountant, to capital gains in the future. So let's say you put 50 grand in a deal, 100 grand in a deal, that deal went bad. You now have 100 grand capital loss minus whatever you may have received in distributions. You do another deal. That one has 100% capital gain on it. Those old capital losses you had, take that off, you pay no taxes on that capital gain. Again, check with your accountant. So you lost a use of your money during that time period. So you had some opportunity cost, but the nominal amount of money you didn't end up losing because you got your original capital back in the second deal plus your capital gain from what your capital loss was. So as long as you keep playing in the private space, you will not lose money. You only lose money when you take your ball and go home because you feel like something bad happened. Well, the big boys and big girls never go back to the public markets after being over here because they had a deal that went bad. Because in the public markets, you can only write off $3,500 a year. So if you had $1 million loss, you're gonna have to take that $3,500 over however long it takes to write that $1 million off. But over here, where the big boys and big girls play, we can lose 100 grand, we could lose $1 million one year, make 2 million next year, and we're not gonna pay any capital gains on that because we had the loss from before and it always rolls forward. So once you move to this side of the world, you want to stay on this side of the world. You want to make sure you keep allocating to this side of the world because even if you have deals that go badly, those will help you from a tax standpoint. So as long as you keep playing and you pick some deals that will make sense down the road, you won't lose. Now, if you keep picking bad syndicators or bad people, then I can't help you on that standpoint. There are enough of us out there that know what we're doing that you're going to be okay. So I just want to make sure we put that out there because people don't realize it, that it's not the same as the stock market. You're not limited to $3,500 a year in terms of what you can write off. You can take 100% of it against future capital gains if a deal goes badly on you. And so again, the only thing you lose is the loss of that money during that time period that you have to roll some new money into a new deal, but you're not going to pay future taxes on it as long as you have these losses in your tax return.
That's a great nuance there. That is what we were here for, those nuggets. That is a nugget. I want to go to the chat. We have a question from Bon. It says, why did you pivot out of multifamily apartment buildings? And when did you pivot?
So we had a 100-unit apartment complex, for those that are in the Houston area, 100-unit apartment complex over in 3rd Ward for Griggs and MLK, essentially. Sold that in 2018, end of 2018, essentially going into 2019. It just, the expense ratios were higher than I wanted them to be. I saw some inklings of inflation and issues around people's incomes in terms of, just incomes, and then what apartments were trading for in the city. And once things stretch past people's incomes and cap rates start going down, they were just better opportunities with higher cap rates and other asset classes where I could then push off more of the expenses to the tenants and not I have to absorb them at the property level. So those taxes that go up, those insurance that goes up, that flows through to the tenants. They take care of that. All I do in my triple net stuff is take care of the roof and the parking lots, right? I'm happy to do that. And so that to me was less management hassle, less expense ratio, and less emotionality, right? And I'll be honest, I'll leave it at that. Less emotionality around the people who are in that space, because that space is where high-level professionals operate, where lots of REITs operate, where people are mostly tied to the property, and they understand that they need to leave some meat on the bone, because to them, ultimately, it doesn't matter if you're a pension firm, you're any of those kind of things that own. If you're a big REIT, you're like, I've used all my tax benefits 7 years in. Here, guys, here you go. We'll give you a 7 cap on this. Bye. And they were lazy landlords, so the property is 72% occupied, when in Houston, it's 95% occupancy for all retail right now, and they're, 50 cents below market in terms of rents. I'm like, yeah, all day and twice on Sunday, we'll take that. And there's just a lot less competition in that space for these types of assets between the $5 to $15 million asset, because they're usually a little too small for the big guys. And most mom and pops aren't in the commercial space. They don't have the connections. Commercial brokers are super insular, and we just pass them amongst each other from that standpoint. So half the deals that we've done, and we probably put up about since 2019, $300 million plus worth of commercial assets here. Half of those have been off market deals. It's just my partners knew the people and we did it that way. So there's a lot more insider trading, a lot more, just a lot more insider trading and a lot more, I would say, professionalization on that side of the world, and just a lot less hassle, right? I got gray hairs now. I don't want to be running around chasing for rents and
Hey, it's
stuff like that.
in now. It's the in thing.
Yeah.
Um, So another question from one of our guests here: how might the projected rate cuts by the Fed in 2024 impact the potential returns and overall attractiveness of investing in properties?
So there's a ton of dry powder on the sideline right now. So what I'm telling people is, if you can get a property that will cash flow in today's environment, you bet to get it. Because when interest rates come back down, prices are going to explode again. And that price discovery mechanism, all the sellers who didn't want to sell when they were a little higher, they can get closer to their price. So you're going to see a bunch of stuff happen. If they drop rates quickly, you're going to see a bunch of stuff happen, right? And from a value standpoint, there's a lot of money on the sidelines right now that wants to be deployed, just waiting. And like every kind of downturn, people swear there's going to be blood in the streets. There wasn't a ton of blood in the streets necessarily in the great financial crisis. There was some, but not a ton, especially in the institutional space. There was single family. There was a ton of blood in the street in single families. But at that time, they didn't know how to aggregate single family like they do now in terms of the institutional investors. I think that prices are going to start ratcheting back up as soon as interest rates start coming down. And so right now is a Goldilocks time period to start doing deals if you can get them. If you can get deals between now and the end of second quarter of 2024, I'd say do it. Don't stretch to do it, though. Make sure it makes sense. But I think in 5 years, you're going to be happy that you bought now, because just like we've been tracing prices up for the past 6 years, we're going to continue to chase prices up because there's just a ton of money on the sidelines. The Fed, even if they got rid of $1 trillion, there's still $8 trillion US floating around the planet, not to mention the yuan and all these other kinds of other money that was printed from currency that was printed from other central banks. And so there's still a lot of money sloshing around the system that wants real assets as we move into the real teeth of the baby boomers needing cash flow to fund their retirement. So if you have cash flowing assets, get a bunch of them now, because I think interest rates, when they go down, that the prices are going to go back up.
Okay. I do have 2 questions. Someone asked, do you anticipate more promising deals coming to the market in the first half of 24 as many of the interest pressure and balloons comes up? And also, do you primarily operate in the Sun Belt?
So short answer, yes and yes for both of those. And so my partners are already saying, hey, get your powder up, get some new investors going. Because I've tapped a lot of my investors out. We put a lot of money on the street in the last 5 years. A lot of my investors are like, dude, my pockets are smoking. And so we're looking to bring more investors in to be able to buy what we're buying. And yes, we think the first half of 24 that, I don't want to say better deals. What I will say is I think there are going to be more deals put on the market. And if people are willing to negotiate, that I don't think they're going to be screaming deals, but I think they're going to be solid singles, doubles. Yeah, because there just wasn't enough of a catastrophe. Rates weren't high enough for long enough. There's just not going to be a catastrophe out there. But I think that there will be deals that make sense in pencil that you don't have to stretch to make sense. I don't think there'll be grand slams. I think there will be, unless you're going to engineer a deal, I don't think there'll be a lot of grand slams. Some people will always find one, but I think the market is going to be solid in terms of giving people good returns over the next 5 to 10 years. And primarily in the Sun Belt, yes, I'm a macroeconomics person. And so I go where the people go and the jobs are going, right? And I stay below the Mason-Dixon line. My dad had a building in Harlem when I was growing up, and it ate his lunch. And so there are professional tenants above the Mason-Dixon line. I don't like a lot of the governmental regulations in super liberal places. And so from a capital standpoint, we want to stay in the Sun Belt and ideally in states that protect capital. And that's primarily, to be frank, are the old Confederacy states. Those are the ones that are going to protect your capital better than anybody else.
I have another question. Let me see. I don't have my Oh, somebody said, can you provide a high-level overview of your initial feasibility process? As in
Wait,
what
you want to do
market
that one or the one before
indicators?
that in the vacancy one before that?
Yeah. Oh, there's one? Okay.
Yeah. Operational question. You
Yeah.
model at current occupancy or property or 10 to 15% vacancy.
And then what escalations do you
Yep.
bake in for taxes and insurance?
So we model. So one of my partners is one of the top commercial brokers in the city of Houston. And so we tend to model current market, but we also know the job growth, right? So Houston puts 50 to 100,000 new people in every year, right? It just is what it is from that standpoint. And the assets that we're buying, they're not building any more of them are. Because the beauty of inflation is anybody building spec retail or spec flex, or people are starting to try to build some spec flex, but we'll see how that ultimately plays out. But nobody's building spec retail. Banks aren't financing. And so you have a limited number of assets, and every type of retailer that's looking to expand is trying to expand into Texas. So you've got this overwhelming demand to be in a place where people are not building more of these assets. Now, they're building some spec stuff out in the suburbs, but we tend to stay in the city, closer to the city core, not downtown central core, but within 25 minutes of downtown central core in terms of what we're buying for the most part. And what we do is we try to we can look at permitting, right? The beauty of CoStars will tell you what permits are on the way, what the expected amount of new inventory is coming. They can see what the historical absorption is. And as long as you're in a market that isn't having a recession, then you don't have to worry about occupancy from an overbuilding standpoint, because you can see what that is. You know that new concepts are wanting to come in, right? And so we really tend to model our pro forma off of current occupancy. But also remember, we buy on 6.5 to 8 caps on performance occupancy of the property. So if the property is 72% vacant, 72% occupied, we're buying at 72% occupancy, and it cash flows at 72% occupancy, right? Anything above that is lanyap to us. So we're not going in with negative gearing or negative cash flow, right? Most of our properties, though I never promised it in the PPM, but most of our projects, 3 months after we close, we're sending distributions out, right? Because they cash flow from day one. We put a big fat reserve in, and we just go forward from that standpoint. So, market occupancy is our final pro forma. We've hit our pro forma number, if that makes sense to you. But we can cash flow from day one in the stuff that we buy. So from that standpoint, we're not modeling it out for future. We modeled it today's current occupancy, but we can cash flow on today's stuff. And then you said high level feasibility process. Yeah, so the way we look at it, if you watch any of my investor presentations, I always walk through a rubric. We do market, team, asset class. So the asset I should say, the asset serves a market need. So you're trying to figure out what you need in the market. So I talked about coffee plantations in Panama, right? So Panama, Central American country, they're like South Beach, Miami, right? There's a million condos everywhere. So it didn't make sense to buy condos there because you're never going to make any money. But the thing that there was a value add was owning farmland. And so the world you may have seen it recently that there's a shortage of coffee. We were buying that back in 2012, 13, because we knew that was going to happen, right? And so some of that is just understanding where the puck is going in terms of what the world is ultimately going to need, in terms of, okay, the world needs this, probably good if we buy it now and just wait for that to ultimately happen. And so we want to be in a market that we like, right? So even if it's a foreign market, so we're in Belize, right? Belize, we were in there in 2011, 2012, right? So before anybody was really ever talking about it, before people knew what was happening, but we knew what was happening in terms of airport expansion, in terms of airlines going in there, all of those kinds of things. And so in many ways, you can be early to a market if the market has great drivers in terms of a young population or job growth or retirement growth or whatever the case may be. Now you're just trying to say, okay, what does this market actually need? Or that's the easiest way to look at it. What does this market actually need? Does it need self-storage? Does it need mobile home parks? Does it need pick your flavor of the day, right? And then you go and find a team that can actually execute what the market ultimately needs, right? And so that's the high level initial feasibility process. No numbers, no nothing. Do I like this market, right? What's the net in migration, out migration? What's the job situation? What's a retirement situation? Because that's a big thing that people aren't factoring into Bureau of Labor Statistic reports is people who are retiring places because they don't come for a job, right? But they have income. And so those places are doing really well, but they won't necessarily show up in job growth numbers. But a bunch of people are moving there in a stealth mode with money in their pocket. My mother was a perfect example moving to Houston like 6 or 7 years ago. No one would account her because she didn't come here for a job, but she's here, she spends, whatever the case may be. And so the warmer Sunbelt climes are where people are going from that standpoint. So those are the market indicators that we look at from that particular standpoint. And again, we just look to see what the actual market needs from that particular standpoint, which is why I'm not doing just one specific type of asset class, right? For me, it was more important that, because again, I don't do stocks. So my money's in all of these deals. And so I wanted a diversified portfolio. Even if we were geographically concentrated, we were asset class diversified. And Houston is a market that's 684 square miles big, right? From one end to the other, it's an hour-and-a-half drive. I actually call it a region more than a city per se, because the drivers in Clear Lake and Galveston and that area can be port related. The drivers out along Katy Freeway can be energy related, two completely different industries, right? And if you're in a geographically diverse city, it's very hard for any specific city just to tumble away from if you're in a tier 1 city, right? It's just not going to happen. You're just not going to have a whole city go like Houston did in the 80s. People don't even realize now Houston is medical and educational as much as it is oil and gas these days, and transportation from a transportation hub standpoint, right? We have the second busiest port in the country. Again, people don't necessarily understand that and think about it from that standpoint. So if you're in a tier 1 market, the chances of one industry taking you down is very rare. So you can geographically concentrate, but I would be very careful about concentrating in a specific asset class per se, if that makes sense.
Yeah, I'm going to actually piggyback on that. So for feasibility studies, we do have 2 luxury senior living. I did with my mentor. So we actually paid a company, right? They can do an official one if you want to do something big and you're not so sure, about the market. So you could pay a company, they'll carry out the whole feasibility study, how many people make. For us, we wanted to make sure they have at least $1 million in retirement, because it's going to be a senior living, right? Luxury senior living. And they give us the number, which particular area has that. Sometimes I don't understand how they found this information, but they found it, how much is in their retirement accounts. So these companies will find it for you. And if you're willing to share that money to go deeper into that. I also like the idea of diversification. We focus on real assets. So this is the whole reason for that, because we go from oil and gas to do self-storages, few offices. We even buy businesses, syndicate businesses. So that's the same reason to diversify your portfolio. Each one has different main points, right? Some are for cash flow, some are mostly equity, and some are for legacy, like George, right? George is into farm land, right?
Citrus.
And mineral rights.
Paraguay.
Yeah, go ahead. Yep.
Oh yeah, there's many investor objectives to invest for, and it's an individual thing, your own goal, and that can change over time too, over the season of your investing career. It's different when you're early in your career versus later in your main hustle. Tax is another thing we invest for. Yeah, a lot of diversity, mineral rights, agriculture, of course, multifamily, and of course, medical office. So, Bayo, I want to definitely hit your question, because it was one of the big talking points, is what factors should investors be mindful of when assessing the interest rate environment going into 2024, Eric?
Again, we can't control interest rates. So all we can control is how you build your models around those interest rates and the assumptions that are being made from that standpoint, right? And so I'm always loath to build models around things I cannot control. And so that's where that pricing is so key, right? Because interest rates are going to be what they're going to be. It's a plug number. It's either going to be high or it's going to be low, right? The thing about that you can't control is occupancy. The thing you can't control is market rents, taxes, insurance. You just plug all those numbers in, and then you model the interest rate, and it will tell you what price you need to pay for this particular asset. And so don't make this stuff more complicated than it needs to be. And then the big thing is also understand the asset class that you're in, right? So some asset classes are hospitality asset classes, right? So hotel, senior living, short-term rentals, those are hospitality assets that use real estate. So you have to have a very good management team who knows how to keep heads in beds from that standpoint with high turnover, right? Whereas self-storage, and even self-storage has a certain amount of, you need somebody there to turn that over. Whereas triple net commercial stuff, not as management intensive. You just have to hope you pick good people who run good businesses from that standpoint. But you don't have to have an expertise level of knowing how to run a business. Your operating partner, your GP, doesn't have to know how to run a business per se to make a good partner. So I think really think of 2024 as a return to fundamentals, a return to not chasing pie in the sky IRRs, but be willing to take a nice return and build a nice diversified portfolio. Because, and I have a talk that I do that basically breaks down, you need 30% minimum of your investment portfolio in private assets. If you're not, you're taking more risk for a lower return. And JP Morgan has done the numbers, and most of my partners that I work with are in Tiger 21. And if you look at their asset class allocation, 50 to 50% of theirs is in private equity and real estate, right? Only 22 to 24% is in the public markets. So from that standpoint, you have to allocate to the private markets just to create a real diversified portfolio. So you can get back to basics. You don't have to hit a 25% IRR in a deal that someone's showing you from that standpoint. You can live with a 17% IRR, right? You're making 17% a year on your money, right? If you do that consistently, you will be very wealthy over time, right? So begin to think about kind of asset allocation, public versus private, more than what's going to give me the highest rate of returns necessarily, because you sure as hell can't control the stock market, right? And the market will probably do okay if the Fed decreases interest rates. The market will go higher, right? And there's just a correlation between the S&P 500 and the Fed's balance sheet. So when the Fed started tightening, S&P hit its all-time high 2 years ago. It hasn't been back since until now, right? There are ways to make predictive understanding around some of this when you understand the macroeconomic environment, but begin to think about next year again, because I can't predict what the Fed is supposed to drop it 4 times. They may not. Who knows? I'm really confident they're not going to raise them. Beyond that, I don't have a lot of confidence. So get back to your basics, get back to basic pro formas. Again, make sure your pro formas are managing to the mediocrity. Make sure you can make money on today's occupancies and today's rental numbers, and make sure that you give yourself a little bit, because we still don't know if there's going to be a recession or not per se. So give yourself a little bit of playroom on the vacancy side and the vacancy factors, maybe 5 or 10% below where your number is. So if you're at 90, think maybe 85-ish, if you want to be a little bit conservative, because again, none of us have a crystal ball from that particular standpoint, but I would say get back to basics right now.
I like that. So it's really not just the interest rate, right? It's so many other factors, right?
Yeah, right now, because the consumer is stretched and we don't know what's going to happen to that consumer, right? And so interest rates going down will help credit card bills and will help some of these things. But, nobody's talking about incomes going up anytime soon. So assume that we're at the upper bound of people's incomes as it relates to housing right now, and move accordingly in that regard.
Yep, I think it's so important for investors to temper their expectation also. In the many deals that we had in 2019, in 2021, you're able to refinance, cash out refinance, pay investor back. And some people are used to that, right? Because all those deals did so well. All the 2018, 2019 deals, most of them exited with 30%. And now, yes, I'm seeing more like 15, 17. And I still see some people that will say 3x your money in 3 years. I screenshot them and send it to Judge on a daily basis. And I'm like, where are they going to do this? Overpromise. It's possible, but I won't even say that, even if I think so in this climate.
We're 15 past the hour. I think this was a great macro talk, and looking back at 23, I think we definitely all have a better understanding of kind of the nature of these capital calls and interest rates and how to look at them and think about them going forward to 2024. So I appreciate your time, Eric. I want to just make sure, does anyone have any other final questions? And then I definitely want to give you, Eric, an opportunity to let folks know where they can reach you.
Yeah, so I'll get, while if people have any last questions, they can put them in. But yeah, so I'm relatively easy to find. You can actually just Google my name, Eric Tait, Tait. But on the Vernonville side, where we do mostly kind of commercial real estate, we do some private debt offerings and some angel investments. It's just Vernonville, www.vernonville.com. You can sign up for our newsletter there. We send out maybe 2 newsletters a month, just talking about these kind of macroeconomic things. And of course, if we have particular deals, you can see that from that standpoint. If you're interested in the venture capital side of the world, where our minimums are much lower, but we're looking at Series A and later kinds of projects, we're at Urban Capital Network, so urbancapitalnetwork.com. You can find my information there as well from that standpoint. So it's the easiest ways to reach me. But again, you can Google me. I'm around. It's pretty easy to get in contact with me. They were asking about the taxes. Oh yeah, there was a question about high W-2 earner from a K-1 standpoint. And so the short-term rentals, as people know, conservation easements were another way. It's not an investment, but conservation easements, but those have been hampered recently. And some people have been doing some interesting kind of donating things that I'm doing a little bit more research on. So I have a lot of my investors I put into conservation easements for a while, but that's changing. And so there's another process that again, I'm doing some research on to see if it's legit. I just got to make sure the operators around it are legit. So that's going to require me to go and meet with them and do all kinds of crazy stuff that I always have to do before I can put it on my platform for anything. Yeah, those are the 2 big ways from a W-2 standpoint. There's some oil and gas things that you can do as well. Again, finding the right operators to be able to participate in that is, again, a more than a notion. And I've been living in Houston 25 years and I still haven't found them. No, but oil and gas, conservation easements, other types of donated services where you get a stepped up basis in it. And there are a few things out there in that kind of way. And then the short-term rental loophole or married to somebody who can be a full-time real estate professional. That's helpful as well. Very helpful.
Awesome. All right. I think we're going to wrap. We're in the middle of a holiday weekend here. Eric, thank you so much. We're going to let folks get back to their families.
Thank you, guys. Appreciate you having me on. Happy to come back anytime.
Absolutely. Thank you, guys. And we'll see you in 2 weeks for our next installment of the webinar series. Until then, happy holidays, everyone. And have a safe New Year.
Great. Happy holidays, guys.
Thank you.
Bye.